Welcome back to today's show here on Dublin City FM with me, Paul Merriman from askpaul.ie. If you've just joined us, like I said, it's all about mortgages on today's show. We've dedicated the full show to mortgages. Shane, let's take it that we've a couple of first-time buyers sitting in a car listening to us this morning. What advice have we got for them? Let's take it. I see this all the time again, or DMs on our Instagram page. Want to start thinking about mortgage? Where do we go? Where do we even start?
Yeah, I think first and foremost is book in for a mortgage consultation. Like, ideally, we'll be looking to speak to somebody at least 6 months prior to them actually wanting to submit an application, just to make sure they've been doing all the right things. We'll help them put a plan in place to make sure when they do submit that application that it's seamless and there's no issues getting their approval.
Perfect. Okay, lovely plug. Over to askpaul.ie, get your mortgage consultation sorted. But I think the big thing here, Shane, fairness, you're right. That's 6 months. Don't go on daft.ie. Don't start viewing houses.
No,
you're already annoying yourself.
yourself.
You're torturing yourself. Get your mortgage for you can't. A good age is not going to let you put a deposit down without seeing your approval in principle anyway. But we'll talk about what that is in a second. So you're right. The first step is give yourself as much time as possible. Ideally, at least 6 months. Okay, what next, and what we're going to talk about first-time buyers?
Yeah, so when you meet with one of the team, we'll bring you through kind of what you need to do to submit an application and what the main criteria that the lender look at.
Okay.
In terms of getting an approval in place. So one of the main things is that you've demonstrated you can meet your future mortgage repayment. So say, for example, your future mortgage repayment is looking like coming in about €1,500 per month. You need to show between your rent and your savings, or if you're not renting, if you're living at home, just your savings, that you're able to put aside at least €1,500 per month.
Or if your rent is €1,800 a month or €1,500,
exactly, then that covers it as well. So once you're demonstrating you can meet that €1,500 per month for at least 6 months prior to the application being submitted, that's ticking that first box for the lender.
And it can be a mixture of both. So if your rent is only €1,300, you can save then the extra £200 or £300 to show the bank.
Yeah, exactly. Yeah. As well as that, a couple other things that you can use as well. If you had a personal loan taken out for a once-off expense and that's going to be cleared, say the repayment was €300 per month,
okay,
that can potentially be added in.
But so this is a really big one here. So just mention that again. It's those kind of once-off loans. So a car loan doesn't count.
No, it doesn't, because a car loan would be seen as a recurring expense. You're going to have every couple of years.
If you took a loan out 2 years ago to go on a holiday or go back to college or something
wedding
like that.
or something like that.
Yeah, they're okay. Once they're being repaid, the money you're paying off those will go towards your repayment capacity.
Exactly, yeah.
Very good.
So that's the first box ticks for the lender once you're demonstrating that. The next, they're going to look at your account operations. So if you've got standing orders, direct debits that they're paid on time, there's no gambling transactions on your accounts.
The gambling's the big one here. Is that catch people out as well? Isn't it? Not that biggest one, but it is a big one.
Yeah, look, if there's one or two small bets within a 6 month period, we can still get it through with the lender.
On Friday, Saturday night, and
if it's every week, if you're up to the limit on your account, if it's taken over, that would raise red flags to the lender. So that's a big no. And like that, just so they see that there's no stress on your account as such. One of the big questions we get all the time is, "Oh, Shane, I'm tapping my card every weekend. I'm going out I'm doing online shopping." That's fine once you're demonstrating you can meet the repayment. You still need to be able to live your life. The lenders know that.
Yeah, this is, I remember people saying before, like, don't shop online and don't buy your, whatever it is. But the bank don't care what you're spending on makeup or eating out or shopping or online shopping once you have your demonstration to repay.
Yeah.
Where I have seen people before, maybe, and where people might get this from, is that somebody hasn't had the repayment capacity and someone said, look, if you cut out this, you'll be able to get the repayment capacity. But the banks aren't going through, snooping through your accounts thinking, oh, they're spending too much on online shopping, we're not giving them a mortgage. The only really red flag is the gambling piece.
Yeah, exactly. Or another red flag would be if you had a lump sum in savings built up, but it's depleting every month, and say you're putting €1,500 into savings per month, but there's €800 coming out of your account each month.
And that is a good point. We've had a couple of clients in like this where they've had decent savings, and I think they're kind of like saving that £1,500 on for a mortgage, but that doesn't count if you're depleting £2,000 out of your savings every month.
Exactly,
because you're going against yourself.
Yeah. So it's just to keep that in mind as well. In terms of how much clients can borrow then as well, so the lenders are limited by the central bank rules, so the max would be 4 times your income as the sole applicant, or your combined salaries as a joint applicant. There's a certain amount of exceptions the lenders can give out to those rules each year, so the very upper limit would be up to a maximum of 4.75 times.
So it is possible to get 4.75 times your income, as long as you get one of those kind of bigger exemptions from the bank.
Exactly, and they all have different criteria around the exceptions. You have to be demonstrating 100% affordability for that higher repayment, which would be the main one with all of them. Then you have to have sufficient disposable income as well, so that's another requirement that the lenders have. What can impact that would be if you have 2 or 3 dependents. So the lender will generally add on additional €250 per month you need to have left over to live on each month per dependent child. So if you're looking for that higher mortgage amount, that 4.75 times income, it can impact things, especially if you have other short-term debt on top of that as well, if you have personal loans or credit card debt.
And this again is something we will talk about switchers in a couple of seconds. Another thing for those people to beware, because they probably had a squeaky kind of clean application first time around, auto savings, everything in, but life gets in the way. Then you have, you know, whether it's we got crash fees coming at you, you might have the car loan, you might have a credit card outstanding, and a few kids. That's how the application can turn quite wrong. So people think in the head, I'm grand, I paid a mortgage, I can get another mortgage, but not necessarily on the snapshot of where you are today.
Exactly, and that's where we come in to, like, we'll analyse all that, we'll run all your details through the different lenders' calculators, and we'll see what fits, and we might turn around and tell you, no, you have to have this loan cleared in order to get you to where you need to be, or you might be fine to keep that loan in place and keep it going to get you the mortgage that you want as well. So
I think the good thing about that is you give the client, Shane, I've seen you doing this loads of times, is the plan. So it's never a no. It's a no, here's the reason, come back in 6 months' time, a year's time, repair this, do this.
Yeah.
At least the client...
You need to do X, Y, and Z, and then we'll get you to where you want to be then at that point.
Perfect.
So they're the main bits and pieces around the affordability piece, your demonstrated repayment capacity, and how much you need to have left over to live on each month. So they're the main boxes for the lenders. So a couple of other things that the borrowers need to keep in mind is, first of all, the deposit requirement. So for a first-time buyer, they have to have 10% of the purchase price built up. If they have a bit of a shortfall on that, they do have the first-time buyer schemes available. So you've got the Help to Buy scheme, which you can get a rebate up to 30 grand of income tax you would have paid over the last 4 years.
I'm going to call out here for people to go on to revenue.ie, register for my account, and make sure you can find out how much, because it's up to a maximum of €30,000. So if you only paid 24 grand in tax over the last 4 years, you're only going to get the 24 grand rebated to you, not the full 30. So it's important to plan to know what that is, really, isn't it?
Exactly, yeah. And the revenue will give you basically an approval in principle for X amount for a Help to Buy refund. So that's before your mortgage approval will even come through. So you can start that process today if you're not sure about exactly how much you qualify for. The First Home Scheme is slightly different. That's where the government will actually take a stake in the property if you have a shortfall between what you have built up in terms of the deposit and what's needed to purchase.
Yeah, I got to call it. I think the First Home Scheme is excellent. I think it's really good. I think it's particularly good for single people, because they're trying to buy on their own. It's pretty difficult for them to do that. So I think the First Home Scheme definitely adds value, and that the government become your partner, if you like, in the property, take a percentage of the equity. The house grows, the equity grows.
And it's the cheapest debt that you'll ever get as well. It's 0% interest for the first 5 years. It moves up to around 1% then after.
That's a management charge. It's not interest. They call it a management charge.
Exactly.
And people think of the way it's a second mortgage. And in fairness, the problem we had in the beginning when this was launched was that the opposition parties were quick to throw mud all over it. But, you know, it actually has worked, I think.
Yeah. So they're the schemes that are available for first-time buyers as well. In terms of the additional funding they'll need to have as well. So the banks don't just want to see that you have your 10% deposit. They'll also want to see that you have enough to cover your legal fees, stamp duty as well. So legal fees are usually around €2,000 for a first-time purchase, and stamp duty is 1% of the purchase price.
They're the things that people always forget, I find. They just think the mortgage or a payment, getting the deposit together, and then you're going to need to furnish a house. Especially if you're going for those schemes, that means you're going for a new build, which is not going to have much in it. So even simple things down to blinds and curtains and things you wouldn't think about necessarily, but you're going to need a bit of a budget for moving in. That's where I see people take the cash back though as well. I see people go for the cash back if they're tight in the mortgage. They might go for a lender that has the cash back purely to give them that little bit of an extra kickstart.
Yeah, Bank of Ireland, in fairness to them, they offer a 3-month deferred start on the mortgage repayments as well for first-time buyers and movers, just to give them that little bit of freedom when they buy the house. First of all, that
very good.
They don't have to make their repayments for 3 months. It gives them an extra influx of cash flow to be able to afford these things without having to resort to short-term debt after finance.
I think that is a good idea as well, staying away from short-term debt and going and getting your stuff on hire purchase or those kind of buy now, pay later schemes, because last thing you want is a load of repayments on top of your mortgage if you've never paid them before.
Absolutely,
because it's going to be a really tough exercise.
Yeah, because you're going to have additional repayments afterwards as well. You have your life insurance that you're going to have to pay for, home insurance, your local property tax, all that adds up over the years.
As well as that, if people are going to get a second-hand property, you might need a structural survey, you might need the valuers, all that type of stuff to consider as well. So what would you give a figure? 10 grand extra maybe per house?
So it depends on the house you're buying, but
obviously the value.
Yeah, but if you're buying a 500,000 house, you've got your €5,000 stamp duty, £2,000 legal fees, and then every other cost you're talking around at least £9,000 on top of your deposit that you need.
Right, very good. It's a good starting point for people to consider. So we're just looking at the deposit, you need to overstretch it. Just quickly, Shane, on this as well, we're talking about deposits, and not many people probably are doing this in Dublin, but outside of Dublin, buying land and getting land as a first time buyer. Can we talk through the one or two tips here in particular, maybe around who's the planning names need to be in, and the kind of people, things that we see people tripping up on?
Yeah, so if it's an application for self-built mortgage application, the title of the property is transferred into, say, the name of the female in the couple that's applying for a mortgage, and the male isn't on the title of the land that's been transferred over. There'd be a tax liability if the mortgage is put into both their names and the title afterwards, because it might have been gifted by her parents. So it's important to know that when you're applying for the mortgage, first of all, so you can advise the lender, and then they can put in a clause into the loan that it's done on a joint mortgage sole title basis, and that removes the tax liability from it. Where we're seeing a lot of clients slip up with self-build applications as well is they're coming to submit an application a little bit too early in the process, so a lender won't generally take an application for a self-build until full planning permission has been approved and they have full costings provided as well.
And that goes back to that kind of advice. So if you're going to buy land and it hasn't got planning yet, you get the planning in your name, put the deposit down to buy it subject to planning being reached. Yeah, so that's the process there. It's actually not the AIP in that situation, because they won't look at you until you have the land. They can see that's in your name and in...
Exactly, yeah. And then in terms of the drawdown process for self-built mortgages, is a bit different to your standard first-time buyer or mover application. So the funds are issued in stages. So your architect will have to confirm that, say, 80 grand worth of works has been carried out on the property. The bank will issue 80 grand, and that will be done in stages right up until when the house is completed. And then the bank will generally hold back the final 10% of the cost of the works until everything is done. They get a
kind of 10% deposit and 10% contingency here, so 20%.
Exactly, yes. So you need to show you've at least 10% of the cost of the works available as a contingency as well. And
in fairness, as much as people didn't like that over the last few years, it's really come in to help having that rule there, because with the cost of materials and the cost of everything going up, especially for the building trade, you're seeing people hearing horror stories of people getting quoted 20-30% over what the original quote was.
Yeah.
And one of the builders are kind of a situation where they can't lose. They're kind of people queuing up to look at the properties and do things. So, good idea to kind of take that into consideration. Okay, so then moving on from first-time buyers, those people that are maybe looking at building their own land or getting land deal to build on. What's the big tips here for switchers?
Yeah, with somebody who's looking to trade up, it's important to remember as well, it might not always be necessary for you to absolutely have to sell your existing property as well. If like we do an awful lot of mover retainer applications as well, where the purchase isn't subject to your existing property being sold. So
very good. But you're looking for really decent incomes here, Shane. Let's be honest, really decent income and a low enough value on the mortgage on the...
Yeah, it depends on the lender as well. So some lenders are much better than others in this. Some lenders will factor in 100% of the future rental income that you're likely to receive.
Oh, well, okay. And your income...
into account.
$2 grand a month, 24 grand a year extra income particular.
Exactly. Let's say the month of your payments on your existing mortgage is $1,500 per month, but the rental income you're likely to get is $3 grand a month, then the lender recognise that's going to cover that.
Brilliant.
And they'll be happy for you to retain that existing property on that basis and then go ahead with the new purchase then. Now, obviously that's subject to you having the deposit built up yourself to put towards it. One of the good things last year that changed was the central bank amended the rules for second-home buyers, and they only have to put in 10%.
10% now. It was 20%, wasn't it, yeah?
It was 20%,
okay, yeah. Again, probably didn't market any good. that you're getting people not selling that second house, or the first house, they're keeping the first house in a rental situation, and it's not going back into a supply at a time when we have massive supply. So although it's want to do something that you can, but yeah, just from a supply point of view, it might be an issue.
Yeah.
Okay, traders.
Sorry, just the other thing on trader others to remember is it's capped at 3.5 times their income at the minute.
So you can't get the 4.75.
They can get it with an exception, but the standard amount, the central bank rules didn't change on that side of things for second-time buyers. So they're still limited by that 3.5.
Okay, very good. So Shane, from a mover's point of view, that's great advice. Let's talk about the switcher market then. So people. We mentioned before you went to the song earlier on, the first part of today's show, we mentioned, people that are going to be in the situation, are coming off fixed rates. They might have been in the fixed rates for 2 years, 3 years, 5 years. We mentioned people rolling off permanent TSB and Bank of Ireland in particular into shop around because they're not going to get the rate that a new customer gets. They're going to put you on less competitive rates, even though you're an existing customer. So you need to be looking around and shopping around instead of getting a 4% odd rate. You could be getting much cheaper. So what do we say to people here from a switcher point of view?
100%. Like, it's very easy, I suppose, just to accept the first offer that comes to you and say, oh, I don't want the hassle. But if you actually look at the savings that you make over the life of the mortgage, by switching onto a lower interest rate, you literally save thousands. Like that example I gave earlier on, the 350,000 mortgage on a 4.1% rate versus a 3.6% rate. The cost of credit for the 4.1% rate of the life of the mortgage is 258,000 versus 222,000 on the 3.6% rate. So you're saving 36 grand there over the life of the mortgage by switching.
Massive, like just that's massive. Because don't forget, to earn that 36,000 as well, you're probably going to have to turn over 60 grand, as in an income of 60 grand, pay your income tax on it, and you get that 36k. So, if you're only on 60 grand a year, it means you're going to work for a full year for no reason, So I'm not going to call it lazy. I'm going to say it's misinformation, people having fear. I would always just book in for the consultation, have a chat and see what the possibility is. And I do that probably a couple of months before the fixed rate comes up.
Absolutely. At least get educated on it, see what else is out there, what's involved. Like I said earlier, the hardest part of it for you guys is going to be pulling all the documentation together. It is a bit of hassle. But once that's done, that's where we take over, we manage it for you, bring it to a close, and look, the benefits of switching versus staying where you are and accepting a higher interest rate.
They far away for a bit of paperwork that you have to do. And again, I said this earlier on the show, it's not the same stress because you're not looking for a mortgage. You're not looking for a mortgage and a house at the same time.
Yeah, and there's other options when you're switching as well, like. You may have been looking at getting the attic done or doing a bit of work on the house. A lot of the lenders, when you're switching your mortgage, will allow you to release a bit of equity, top up your mortgage a little bit. If you wanted to get the kitchen done, whatever it is, some of them don't even.
And Shane, what kind of money could you release in that situation without too much kind of?
So without too much hassle in terms of going through
valuations and builders and kind of statement of works and that type of thing.
So the most is 75 grand with Haven. So they just require you to fill out what they call a self-certified costing sheet. You just confirm from you're looking to do X, Y, and Z. Total it up to 75 grand, send it in, and that goes in with your mortgage application, and then they release that full 75 grand of funds up front. When you do it, some of the other lenders bit less, so with Avant you can do up to 20 grand without full costings. Bank of Ireland, PTSB, you generally need quotes for the works, but they'll allow you to do it as well. If you're looking to do anything structural, it'd have to be signed off by a supervising architect or engineer, so an architect or engineer would have to send in cost and search confirming you're looking to do an extension.
And in fairness, that's for the bank to make sure that the bank have a house that's being built correctly.
Exactly.
And they're not going to be left with an extension that's devaluing the house or can't be sold in the future. They have to repossess it.
Yeah. Exactly, yeah.
Okay, so look at protection.
Actually protect themselves by actually having an interest in the property as well. So
a few questions have come in. We're going to answer them, Shane, that's okay. The first question, and I didn't actually realise this, to be fair, and this is exactly why you're here. AIB don't allow you make additional payments in fixed rate term without breaking the fee, and that comes in from a profile called Cinders. That's true. Is it?
Yeah, so some lenders are more flexible than others when it comes to their fixed rates. So AIB don't allow any overpayments or large lump sums, or you'll incur a breakage fee. Bank of Ireland, they'll allow you to
10% of the repayment amount,
repayment per month.
So if you're paying 1,500 quid a month, you can do
150.
Yeah.
It's the most flexible at the minute. It's probably Avant. So they'll allow you to clear off up to 10% of the outstanding capital balance per year.
That's amazing. With a 300 grand mortgage, you can put 30k off and not have any type of...
Somebody who's receiving large bonuses every year and you want to have that flexibility, Avant might be the lender for you.
This is actually something from a financial planning point of view for listeners to be concerned about, because like a few years ago, and this is why I'll always say, be careful where you're getting content, where you listen, and make sure you continue listening, because advice from 2 years ago is now pretty much stale. Like if a client had come to me 2 years ago saying of 30k bonus, I want to clear it off my mortgage, I would have said no, because they probably were paying 1.9 or 2.2%. But now if you're paying 4.1, say, coming off that Bank of Ireland fixed rate, yes, you should be, because you're not going to need to get about an 8% investment return to make that money work the same at that 4%. So we're getting a lot more clients in our financial planning consultations considering what do we do with this lump sum. Now, to be fair, from an advisory point of view or a financial planning point of view, if I had a client that had a lump sum, it'd be very rarely I'd say knock it all off the mortgage. You're probably going to use it as part of a robust plan, emergency fund, clear a bit of short-term debt, definitely pay down the mortgage a bit, maybe make an ABC to the pension plan, get tax relief off last year's tax that was paid or tax back. So there's loads of things to do. But so AIB, don't know how you do it. The other lenders are a bit more flexible. What about permanent TSB? You fix it. You have to reduce the term, don't you?
Yeah, they'll allow you to make some overpayments, and it basically goes into a fund separate to your mortgage, and then at the end of your fixed rate, you have the option of adding it to the account and reducing the balance.
So again, depend on your fixed rate. If you're a fixed rate in for 5 or 7 years, in my opinion, you should be investing that money rather than sitting there, because it's not really saving any money putting it in and sitting in the side account, is it?
Exactly, yeah. So
it's just kind of out of sight, out of mind, that case, isn't it? That you kind of, it's gone off my mortgage. Has it really gone off my mortgage? My mortgage company just hold the money for me.
Yeah, so again, this is why it's so important to be getting proper advice and going to a broker and give you whole of market advice, because that's what might be important to you, having that flexibility on the overpayments.
Yeah, and we all know everyone's different when it comes to financial planning. Okay, question here. How much is a consultation, please? And that comes in for Christine.
Mortgage consultations are currently free, so we don't charge you anything for the advice we're going to give you.
Okay.
Regardless of whether you're submitting an application or not. So
okay, so over to askpaul.ie, get it done. Okay, if my tracker is ECB plus 2.5%, is it still worth holding on to? Absolutely not.
2.5%
above the ECB. That's robbery.
Yeah,
that's a really bad tracker rate. So just for listeners, the ECB rate, when it was 0, if you had a 1% tracker, you're paying 1%, and if the interest rate increased now to what's 4.25, so this person is paying 6.75%.
Yeah, I'd imagine what probably happened there is they probably moved house probably somewhere along the line, and most of the lenders will offer what's called a tracker for mover product. They add on an additional percent onto that.
So that was probably 1.5 and went to 2.5. Yeah, that's robbery though, 2.5. And as well, just to say, this is really interesting as well for hopefully for listeners. When the European Central Bank was 0, our banks were charging an average of 2.8%. Okay, so we know the European Central Bank is coming down. I think it will settle at 3, maybe 2. Actually, I don't really think it gets 2.75, but if you really want to be hopeful, in that case, you're going to have your 2.75, or let's call it 3, and that 2.5 rate on top of it. So you're probably going to continue to pay 5.5% when we know we can get way cheaper.
That they could be 20 years before that rate comes back down to where it was before. Whereas there's rates now that could be getting half of that.
Well, if you look at, let's use the Avant example there. They've got 3.9% fixed for the term mortgage.
3.6 on a 4-year or 3.8. You can lock it in the entire term under one mortgage product.
3.8 now to one mortgage product.
Yeah, if it's less than 80%.
That's a big difference. Yeah, so guys, and just this is an important question, important thing for people to consider. If you are on a tracker mortgage and you don't know what that's called, the margin. So this person, that's Christine, was talking about her margin, or sorry, Rachel was that one. Rachel was talking about her margin is 2.5% above the ECB. If you don't know what your margin is, ring your bank ASAP, first thing Monday morning, ring the bank and ask them, what is my margin? And if it's anything above, I'm going to say 1.25 or 1.5. 1% is not too bad, because the European Central Bank comes down to 2.75. If you're really lucky, you're going to pay 3.75. But don't forget, guys, rates come down and go back up. We're just been in a really fluke environment for the previous 6 or 7 years. So just because the rate might get down to 2 or 3% doesn't mean it won't go back up to 4 or 5% over the lifetime of your mortgage. So they are cyclical, they do go up and down. Okay, anything else in that one, Shane, just in relation to that 2.5, which are pretty much the same as me?
Exactly the same. Like, you can get an interest rate at the minute that's half of that, which, depending on the size of the mortgage, that's going to save you hundreds of euros in interest that you're paying every month. It's needless interest that you're giving to the bank, and it's not clear much down off your mortgage.
Yeah, very true, very true. Okay, next question in here is switching like a new application. Lost my job since drawdown, but my husband earns the same.
It is a full new application, but it doesn't fall under the same central bank criteria as your standard first-time buyer or mover case, where you have to be within 4 times for a first-time buyer or 3.5 times income for a mover. It could be that now it would qualify based on your husband's income alone, even though you're not currently working. So it might be at 5.
Yeah, so the rules aren't the same.
It might be at 5 times his income, say, for example, the mortgage.
They're still down to the bank's rules, really, but the Central Bank of Ireland's their guidelines don't come in.
Yeah, so the bank will still consider it once you're meeting all their other criteria. So
right, okay, very good.
It is a full new application again, though.
Right, okay. We've actually kind of touched on this already. Consider buying land off my uncle. How do I go about the mortgage process? Just in case anyone missed the previous segment on the show, let's bring listeners through that one, Shane.
Yeah, so if they're looking at purchasing the land through the mortgage as well, they'd have to be planning permission on it already. So
in your name, in their name.
Yeah, and in their name. So if it's a case that there's no planning permission on it, they'd have to look at maybe doing a land loan, or finance it up front themselves if they have savings. And then after they've done the purchase, then they can get a self-build application underway once planning permission has come through.
Okay, very good. Next question, last question for today is coming in from Erica. Can I use a gift as my full deposit from my parents? It's going to be about 35 to 40,000 euro. Do I have any tax issues also? Okay, two parts to that question. Number one, I'll take the tax piece, Shane. So number one, you can actually receive from your parents over your lifetime 335,000 euro. So if they're going to give you a gift of 40,000 euro now, providing they haven't already given you 300,000 euro, you're going to be absolutely fine. So there's no what's called capital acquisition tax, that's 3% to pay there. You should be fine. Okay, Shane, over to you for the rest of the advice on that one.
Yeah, regarding the deposit and taking the entirety of it as a gift, it really depends how much you've been demonstrating you can repay for it.
So you need to show that repayment still.
Yeah,
so if you've been renting though for $2,000 a month, you should be okay if your mortgage is going to be under $2,000 a month.
Exactly. Say for example the mortgage repayment is going to be €1,400 per month, but you've been paying rent $2,000 a month. Yeah. Then it's feasible why you wouldn't have been able to build up any savings there, which the lender understands. But they know that you've demonstrated you pay $2,000 a month here. Your mortgage.
Good case though.
Yeah, you have your deposit built up through your parents. They're going to gift you the funds.
Brilliant.
That will be fine. They'll also want to see that they're gifting you funds for the stamp duty and legals and all that as well if you've got nothing in savings.
Oh, very good. That's a really good point. And does that show, how do people show that gift, Shane? Just bring listeners through maybe technicality. They have to show a bank statement from the parents or the letter of intent for the mortgage application, or what is the process there? So
in order to get a loan offer issued, so once they've gone sale agreed on a property, they'll have to provide a gift form signed by their parents. So the parents are confirming they're going to gift them 40 grand towards the purchase. They have no interest in the property and the gift doesn't have to be repaid. And that would be signed off by them. And then before the bank would issue the funds, they'd need to see a bank statement confirming those funds have been received into their account.
Brilliant. Okay, excellent. Shane, thanks very much for joining me in studio today. That was a brilliant session. I hope you added value to listeners. And Shane, we'll probably get you in every couple of months to give people that update on the mortgage scene, because I know it's a really popular topic for people out there at the moment place. And so many people are caught between a rock and a hard place in relation to renting. We're still looking at people that can't move houses. They're looking at maybe borrowing now on a short-term rate to do up the houses, and looking at putting extensions on or going up into the attic, as you mentioned. And all. So we do see it nearly every day in askpaul, every single scenario you can imagine with people moving. So it is important.